So if you're watching the current economic cycles, you're probably asking yourself the same thing everyone else is, especially institutional managers.
Uh-huh.
Where do I find reliable, counter-cyclical assets? We're all searching for places that offer not just returns, but real stability, predictable cash flow.
Right. Especially with traditional real estate, things like offices, retail, they're seeing just huge volatility.
Exactly.
And that quest for resilience, for something that pushes back against the business cycle. Well, that's exactly what we're diving into today. We're taking a deep dive into senior living and care homes.
Right.
But look, before we even start, it's really important to say this isn't just one thing, right?
Good point. It's a spectrum.
Totally.
Right.
We're talking about everything from highly clinical, very regulated skilled nursing facilities.
Oh, great. SNFs.
All the way through to market-driven assisted living centers and even, more residential retirement communities, broad.
Okay, so let's unpack this then. The source material we looked at, it really positions these operational real estate assets as, critical, right? A really critical counter-cyclical piece for a diversified portfolio.
Yeah.
And the core thesis, the thing that seems to set this sector apart, it's driven by need, isn't it? Like non-discretionary demographic need.
That is the absolute key takeaway. It's a powerful distinction.
From, say, retail or office space.
Exactly. Because most real estate depends on discretionary activity. You want to buy that shirt? Do you need that massive office tower right now? Maybe not.
But senior living.
Senior living depends on something, biological. Aging. It's a certainty.
You can't defer it.
You can't. When we talk about senior care infrastructure, the demand is just rooted in the inescapable reality of a rapidly aging population globally.
The need for a dedicated place for care, it's just not optional for many people.
It simply isn't.
Okay, that sounds compelling in theory. But let's try and put some, macroeconomic weight behind this idea of inevitability. We've got some insights here from Dr. Pooyan Ghamari, the Swiss economist.
Right. And what's fascinating with his perspective, he really emphasizes that strategic investments, the long-term ones, they absolutely must align with these huge, undeniable global megatrends.
And aging is one of the biggest.
It is. He views the aging population in developed nations specifically, not just as some social thing happening,
Right.
but as a clear macroeconomic signal, a really strong one.
A signal pointing towards
Sustained demand. Non-negotiable demand for this specialized infrastructure. I mean, look at the demographic dependency ratios. They're shifting so fast you just can't ignore it.
So you're basically arguing then an investor isn't just speculating on, say, the market recovering next quarter.
No.
They're placing a direct bet, a high-confidence one,
Exactly.
on a demographic shift that's already happened and is, frankly, only speeding up. It's an investment in a fundamental human need.
Precisely.
Yeah.
Investing here is a direct play on that demographic imperative.
Yeah.
And because of that, it offers a predictable return profile, something that naturally complements other assets, the ones that are often more volatile.
And that predictability, that stability, that's what gets the attention of the big players, right? The large institutional funds, corporate investors.
Immediately. They're actively looking for genuine portfolio buffers,
Yep.
and this fits the bill.
Okay, all right. Let's shift from the why to the how, from theory to mechanics. How exactly does this guaranteed demand translate into the stable, predictable cash flow investors want?
Good question.
Because, investors are naturally cautious, especially about anything promising low risk in operational real estate. It can be complex.
Absolutely. So let's look at the key financial mechanisms that actually structure this stability. First, and maybe most critically, is the leasing structure.
Okay.
These assets, they typically operate under really long-term agreements. Think 10, 15, even 20 years.
And often structured as triple net leases, NNN.
Often, yes. NNN leases are very common.
And maybe just quickly for anyone listening, triple net means the tenant, the healthcare operator running the place, they're responsible for property taxes, insurance, and maintenance costs.
Exactly. And that mechanism is huge because it shifts a lot of the operational risk away from the asset owner, the investor, and onto the operator.
Which generates
Highly predictable, pretty hands-off revenue streams for the owner. Over a decade or more. Very stable.
Okay, but I have to push back a little on that stability point. Just playing devil's advocate here.
Go for it.
If we're talking about, say, skilled nursing facilities, the SNFs, their cash flow depends heavily on reimbursement, right? Government programs like Medicare, Medicaid.
That's true for SNF, yes.
Doesn't that expose the asset to massive policy risk? political risk? I mean, one legislative change could suddenly slash profitability overnight. That doesn't sound stable at all.
That's a really important question, and it highlights why distinguishing between the asset types is so crucial.
Yeah.
Your point is absolutely valid for S&S. They're high regulation, often lower margin businesses focused on short-term medical recovery. And yes, institutional investors must factor that legislative risk into their valuation. Policy volatility is definitely a real factor there.
So how do investors manage that?
Well, first, they price it in. But second, remember the spectrum we talked about. A large part of the market, particularly in assisted living and retirement communities, is driven by the private pay market. A really robust one, actually.
So the resident or their family pays directly.
Exactly. Cash flow there is insulated because it's market-driven, not policy-driven. These segments usually offer higher margins, too.
Oh, okay. That makes sense.
So savvy institutional investors, they often diversify. They might hold some SNFs, balancing that regulatory risk with the higher margin potential of private pay assisted living or retirement communities. It enhances the overall portfolio resilience.
Got it. That distinction is really key. Okay, so we have stability. But the true value of a counter-cyclical asset, it's also about diversification, right? Performing differently, maybe even well, when other sectors are struggling.
And this is where it gets really interesting, I think.
Yeah.
Our analysis, and the sources confirm this, shows these assets offer true diversification. And the reason is
Low correlation.
demonstrably low correlation with traditional cyclical sectors, office, retail, hospitality. They march to a different economic drumbeat.
Which is that core principle Dr. Ghamari talks about.
Exactly. His point is that long-term strategies have to include assets whose demand drivers are basically independent of the general economy.
Right. If the stock market tanks,
Yeah.
people still need a place for their aging parents. The need doesn't vanish.
Precisely. The need persists.
Okay, beyond correlation, let's talk about inflation. It's a persistent threat, especially for long-term holds. It just erodes real returns. Does senior living offer any kind of defense against that?
It does, actually. A pretty powerful built-in defense, an inflation hedge.
How does that work?
It's baked right into those long-term leases we were just discussing.
Okay.
Many leases in this sector incorporate inflation-linked rental escalators.
Contractual clauses.
Yes, contractual mechanisms, often tied directly to something like the Consumer Price Index, the CPI. They automatically increase the rent year over year.
So just to make that concrete, if inflation is running at, say, 3%, the rent on the facility automatically bumps up by a similar amount.
Basically, yes. That's the idea. This mechanism helps investors maintain the real value of their cash flow, their returns, even when prices generally are rising.
Are there limits?
Usually, yes. These escalators often have caps and floors built in, which provides predictability for both sides. The operator isn't hit with sudden massive jumps, and the owner has some downside protection.
Makes sense. That predictability must be attractive to certain investors.
Very attractive. Especially to pension funds, insurance companies,
Yeah.
anyone who really prioritizes predictable real returns over the long haul.
That makes total sense for preserving capital long term. Now, the source material also mentions something about technology boosting investor confidence, enhancing operational efficiency. Can you elaborate on that a bit?
Absolutely. I mean, the need for care is essential, as we've said. But running these places, it can be complex. Operations matter hugely.
Right.
So investor confidence definitely gets a boost from technology that improves efficiency. Think about compliance tracking, staff scheduling, health monitoring.
Okay.
We're seeing platforms, like the ALAM platform was mentioned, facilitating specific software solutions and digital tools for operators.
And what does a platform like that actually do? Is it just like a digital filing cabinet or more?
Oh, it's much more substantial. It's fundamentally an optimization tool.
How so?
It lets operators manage resident records much more effectively, but also optimize staffing ratios, which is a huge operational expense, streamline billing, handled compliance reporting more easily.
So it cuts down on the admin burden.
Exactly. It reduces that administrative friction, helps allocate resources better, which ultimately lowers the operator's cost burden.
And a more profitable operator.
Means a more secure tenant, which boosts the long-term value of the underlying real estate asset itself. It adds this sort of technological layer of stability on top of the physical building.
Got it. Okay, let's shift focus a bit now. Looking forward towards future opportunity. a lot of the existing investment, it seems, has really flowed towards the high end, the luxury communities. Great margins, wealthy private pay residents.
That's definitely been a major focus, yes.
But where's the greatest scalable opportunity maybe lying untapped?
That really raises a critical question about market segmentation, but also about, well, societal necessity.
Okay.
Because you're right, the luxury market is pretty well covered. But there's a substantial, critical, and frankly, growing opportunity in the mid-market.
The missing middle, as some people call it. Why are investors maybe avoiding that segment currently if the opportunity is so big?
It really comes down to cost and regulation primarily. New construction is just expensive, period. And it's genuinely challenging for developers to build high-quality seniors housing that the average middle-class retiree can actually afford, especially if they're relying mostly on fixed income, maybe some equity from selling their home.
The cost to build isn't that different between luxury and mid-market.
Not fundamentally, no. The construction costs can be quite similar. But the high-end community allows for vastly higher monthly fees, right? So the potential return profile looks much better on paper, driving investors towards that luxury segment.
So you end up with this huge pool of demand, basically the entire middle class needing options, but there's a structural barrier. It's hard to build the product at the right price point for them.
That's the challenge.
So why should investors try and tackle that challenge?
Oh, because the potential payoff is based on genuine scarcity. If you can figure out how to create affordable, high-quality seniors housing for this group, you're solving two massive problems at once. You're providing a clear, undeniable social benefit, and you're addressing a critical, gaping undersupply in the market.
And that translates to?
It secures a long-term, high-occupancy tenant base, almost guaranteed. If you can solve that affordability puzzle for the middle market, your occupancy risk practically disappears. Demand is just that strong.
Interesting. So you get better societal outcomes and potentially better, more stable business fundamentals. That convergence, capital meeting necessity, it feels very relevant today.
Absolutely. And this focus on verifiable societal need, on addressing that missing middle, it aligns perfectly with modern institutional mandates, especially ESG goals, corporate social responsibility.
CSR, right.
Dr. Ghamari's work also highlights this. That inherent social utility, solving a real problem, it can attract increasingly mission-driven institutional capital.
Funds that want both financial return and social impact.
Exactly. They're actively looking for assets where strong financial fundamentals are basically inseparable from solving a critical social problem. It becomes a kind of virtuous investment cycle.
Okay, so pulling this all together, what does this mean for you, the listener? Someone trying to position a portfolio against, economic turbulence.
Yeah.
The core investment thesis we've unpacked here really hinges on combining that non-negotiable demographic, demand the certainty of an aging society, with these built-in financial defenses, things like the long-term NNN leases, the inflation escalators.
Right. And knowledge is really most valuable when you understand it and can apply it. The key insight, I think, that we've uncovered is that dual benefit. This asset class offers an investment that is strategically stable because it fills an undeniable societal necessity.
The stability comes from the necessity.
Precisely. So for you, the listener, maybe the next step isn't just understanding the asset class, but considering the geography of demand. If demographic trends are non-negotiable, the really critical question you should ask yourself is this. Are you investing just where the population is aging? Or are you investing where the service gap, that unmet middle market need, is growing the widest? Because that gap often represents the most resilient, the most predictable, and potentially the most impactful return over the long term, where need meets opportunity.